some of the things that get you pretty excited as you kind of are thinking about the future?
So let me frame that response, Mike, by saying that I'm an active investor in 12 or 14 different funds around the world. And full disclosure, an active investor in VC Lab and its parent company, Decile. I love working with, and my focus, as I said, is early stage. So I tend to work with companies and funds that are doing a lot of early stage stuff. I do have some later stage things, but it's a smaller percentage of my activity. In terms of what I look for, I think it's unique thesis and capability to pull it off, right? So if I'm picking a manager, I'm picking somebody that I think is attacking a market or a market opportunity in a differentiated way. And differentiated might be geographic focus. So, I have funds that I support all over the world because sometimes it's about putting money where the entrepreneurs are as opposed to making the entrepreneurs come to the money. So that and the fact that I tend to personally focus on things that I think are changing society for the better. So if it's a fund that's really just focused on enterprise productivity and efficiency in business, surprisingly, even though my background is largely in that area, that's not where I tend to invest. I tend to invest in things that are going to make the world a better place.
Martin, you talked a little bit about, like reducing friction and things like that. What are some things that you're particularly excited about, especially as you're kind of trying to go direct from the company level?
Well, I focus just on pre-seed, and as a recovering entrepreneur, probably like Court, I think the most exciting part of the entrepreneur journey is that sort of sub 50 employee journey, where you're still trying to figure out what the product is. You've got limited resources. You've got to make hard decisions about what customers to do, product features to do, and things like that. And so I'm always excited about that early technology phase. And I just wrote something, I haven't published it on my blog yet, but I think this year in particular, there's two pretty interesting verticals. I'm a software generalist, so I've invested in B2B and supply chain, like all different verticals. I'm also geographically diverse. I invest about 40% internationally and about 60% in the United States. So I'm kind of agnostic about geo and vertical, but I do have particular themes that I like. And the two themes that I'm looking for in 2023 are vertical market software applications and middleware companies. I just invest, and reason I think those are really good today is that vertical market software companies are companies that build specific applications to replace general purpose software that was used before. For example, anywhere you see somebody using an Excel spreadsheet, if you can write a vertical market software application for that, I think that's an amazing opportunity, and it's cheaper than ever to build vertical market software quickly with cloud services and things like that. The second one is middleware companies. I just invested in a company in Africa, which is building kind of a Plaid-like fintech middleware API first connector company to connect all the banks in Africa so fintechs can write fintech apps faster. And I like middleware companies because they tend to be rocket fuel to create entire categories. If you think of things like Plaid and how many fintech apps we have because we have Plaid made it easier to connect to the banks. These middleware companies can be companies that build entire ecosystems on top of them. And those are two things I'm really excited about this year: vertical market software and middleware companies.
A lot of people kind of reached out to us, via email and things like that. And just one of the questions we could kind of get is like, what are your thoughts on just this year with all the changes in the markets? How do you see the market outlook, and how do you see that affecting venture capital and startups? And you personally, maybe as an LP, Court, how does that affect you, and how do you think about that? Any thoughts there for the audience?
Absolutely. I think data, and I know Martin will back me up on this, suggests that the early stage investments are thriving. It's right now the capital markets are kind of stalled, so the middle to later stage stuff is having a really hard time finding new money. and as having to go into a cost conscious survival mode for a little while they wait out their growth rate. Early stage stuff is thriving. Valuations have stayed relatively strong, come down a bit, but not terrible. So like I would imagine that a lot of the folks listening to this call, if you're starting funds that are looking at early stage in your region, you're going to see some really great stuff coming your way. And I think it's still going to be very promising and strong.
And then your outlook for, especially thinking about like potentially being an LP in future funds and things like that, for all the new managers out there, how are you thinking about that? How are you thinking about allocating, reallocating and things like that, given the market conditions?
I think it's smart to keep powder dry for a little while for a lot of people, just sort of managing the economic cycle. I myself have kind of pushed a pause button for a little bit on new active investments. I'm supporting all the stuff I've currently invested in, but I wait and see when the economy stabilizes. It's not an if, it's a when. When the economy starts to be a little more predictable, I think there's going to be some incredible opportunities. And I think, if you've got capital ready to deploy now, you're going to do great.
Yeah, I can't agree more. How about you, Martin? I know you've talked a lot about you haven't invested for a long time. How do you compare this period to kind of previous periods where you've been investing in?
I've been investing through the downturn in 2000, 2008, 2020. The fact is, new funds that are created with a vintage date right after a crash tend to be some of the best performing venture funds ever, because they're investing low and they're not spending a lot of time working out prior high markups from prior funds. So if you can raise a fund, I think it's a great time. We did our first close in November, and we're deploying capital. But from a GP perspective, what I think is going to happen this year, we did have a real constraint in Q4 of last year, where people were trying to figure out what the prices were, and a lot of especially early stage guys going for their seed round were not really wanting to remark their companies. But we have in Q1 started to see pre-seed deals and seed deals being able to be marked at the current market, which is frankly down in a similar way that the late stage deals were down 60-80%. Pre-seed and seed deals have come down maybe 50%, but deals are starting to get done now, because I think we're getting a little more agreement between the VCs and the venture capital and the founders on price. But that's the real thing that has been holding back the market, is just agreement on expectations of price. So I agree with Court that early stages deals are happening, albeit at slightly lower valuations. My base case is that we're going to see quite a good bunch of funding in Q1, but I also think that funding gets a little harder before it gets easier again. I think we're going into a double dip in a bit of a recession. And the other thing that's coming in to the market, people have tweeted about this on Twitter, is this zombie apocalypse of companies that got funded 12 months ago or 18 months ago that are now starting to run out of capital. So a lot of early stage companies that are just going for their first capital are now going to be competing against companies that got funded during the bubble 12 or 18 months ago, looking for follow-on or bridge financing. And VCs are faced with the choice of having to invest in a new company with no traction, or in a company with some traction at sometimes a very similar valuation. So the funding environment is going to get more competitive for first-time entrepreneurs, because you've got this backlog of second round people coming to the market in mass in Q2 and 3. I still think the companies, with the best traction and best management teams will get funded, but VC inboxes are going to be flooded for the next 6 months.
Everyone, we're doing this for you. You've got already 10 open questions in the Q&A. If you have other questions, please add them to the Q&A and upvote, and we're going to prioritize your questions. And I'd love to kind of make this as interactive as possible for you. So please add your questions to the Q&A. Myself, Court, and Martin want to answer your questions. I do want to just quickly double click on that a little bit though, Martin. So there is a difference, right, between like later stage, early stage, in your case, pre-seed, right? And so the a lot of it obviously was allocated at the later stages where you see these very large funds and things like that, and they're having an effect on the market. How do you see that as being different versus, say, like medium stage and early stage?
Well, I only do pre-seed and seed. So what I'm talking about is what's happening in seed. I'm not even talking about what's happening to the Bs and Cs and Ds. What I'm seeing today, like I saw 3 different companies last week at 3 different valuations with the same traction. They were all on basically a $300,000 ARR run rate, B2B SaaS software companies. One was $5 million, one was $10 million, one was $15 million. So the spread in terms of valuations that you're going to see for companies is the widest that I've ever seen it, which makes it hard for VCs to decide which companies to invest in. I'm seeing pre-seed companies, pre-product raising at a 10 million pre, and the next deck I look at is a guy, with $300,000 in ARR and a year and a half of traction at 10 pre, right? This is what's causing confusion in the market, is that VCs are being presented with vastly different, traction metrics for very similar valuations. Which is making it difficult for especially the earlier companies. The primary, what I'm personally doing, obviously, I'm spending more time with the $300,000 ARR company at a $5 million valuation than the guy at a 15. Just simply, it's a better risk return reward for the VC. So it's a challenging environment. I saw a company yesterday. A second-time founder. He started a pretty successful PC software company. Anyway, pre-product, 6 months from shipping his MVP. He wanted to raise $1 million at 20. And I just told him, I'd like to know what he's smoking, because, I'd like some of that. But this is the problem in the early stage market, is adjusting, finding the right bid-ask spread. And my point of this year is that VCs are going to get presented with many, many higher traction opportunities at lower or fair values, which is going to cause first-time founders competition, which I think is going to drive those first-time deals down soon, even lower. I'm talking to a founder right now, and this is just some market data. Second-time unicorn founder. This is in sales process automation. He's raising $300,000 at a $3 million pre. He's going to get that deal done in about 5 seconds. He could probably ask for 15, but he would take a lot of meetings and it would be hard to get done. He's being smart and raising the money quickly at a low valuation.
I see you shaking your head a lot, Court. Do you have any thoughts on this topic?
Oh yeah, no, I've watched this cycle as Martin has, 2000, 2008, and now this. It's the same cycle repeated again and again, and it's just funny to watch how people interpret the signals, and how they, Martin's right. To you as the investors and to the entrepreneurs as founders, the best deals are the ones that happen quickly and are easy to sign off on. So that deal, the 300K at 3 million pre, it's like that deal's going to have, he's going to waste his time raising money, right? He's going to build his company, and that's what you want as an LP or a GP. And that's what the investor, all the investors and entrepreneurs want. So realistic expectations are sometimes hard to come by. But if you filter for them, you're going to find probably the better founders, to be honest. I would honestly say that that's a litmus test for a founder in many ways. And so, keep your eyes on people like that.
The most upvoted question here from Bernard, and maybe we can send this one to you, Court. what attracts an LP to invest in this 2023 vintage fund? What are some like interesting qualities that maybe a GP should have?
Well, I think that, if the GP has a track record of investing themselves, I think that's the first thing that you're going to put forward. The sector, if they're, if it's a sector of interest to the LP, I think the thing about LPs is just like being a direct investor in a company, you don't need the best pitch or the best thing. You need to be the best thing that that person's looking at in the moment. Okay, so if you're trying to attract LP capital to your fund right now, you just need to find the people that are going to be attracted to your story, your history, your direction, your thesis. And they're out there. And, again, give them an opportunity to see you for what you are and be authentic. Share your wins, share your losses, with things you share your lessons learned. The more authentic I think you can be, the better suited you are to people wanting to trust you. And at the end of the day, that's what they're doing. They're trusting you with their capital, right? They could take their money and invest it wherever they want to. They're putting it in your hands because they think you're going to do a better job than they could do by themselves. So give them every reason to think that way.
There's a couple of questions here. They're essentially saying the same thing, Martin, which is, any kind of pieces of advice, any tips on kind of getting to like that first close? So you just kind of went through this. Any advice you'd like to give folks here on the call?
I really like what Court said about being authentic. You need to create a real connection, with the LPs, and hopefully, it's over some shared interest. I listened to the thing you and Adeo did the other day, and you were talking about finding shared interest or things that you care about that are the same as the LP cares about. Court just mentioned he cares about world-changing things. So if you know that about him, you should talk about that as opposed to necessarily just your IRR. I think the biggest thing I did on the first close was, a lot more research, about the people I was potentially talking to, reading their Twitters, reading their LinkedIn, doing, personalization of the pitch, not just, here's my deck, do you want to invest? You've got to do that extra work of trying to understand and tease out things like what does this person care about, so that if I care about, now, if you don't care about what they care about, don't lie. But if you find some mutual connection, then spend time talking about that rather than just going through your pitch deck. Try to find those authentic connections and double down where they are those, because that's going to make it more fun for you. For example, I just got a new LP yesterday. He runs a hedge fund. And one of the reasons that we geeked out about is I was just pitched an AI hedge fund company. And I said, I just got this pitch. Can you help me look at this thing? Because you know something about hedge funds. And he said, yeah, I'd love to do that. That's one of the things I like to do as an LP, is to help on diligence on companies that I know something about. And so, we nerded out about AI hedge funds before he even decided to write the check. But that just naturally came up.
I know this is a topic that's near and dear to your heart, Court. Any thoughts with regards to kind of how LPs can help, like diversity and diverse-owned like fund managers and things like that? Impact.
Now, LPs can help with that. Well, there's always a question of sourcing deals. So if if LPs are helping the funds they invest in see new opportunities or meet new founders, that's certainly a way. I think in a lot of ways, it largely comes down to voting with your checkbook, meaning as LPs, I will consciously choose to work with people, as I say, whether it's geographic, racial, economic, different places that are maybe underrepresented and need some assistance, or would benefit by having some additional access to capital. I might choose those GPs, those funds as part of my capital deployment strategy. And I actively search out and find fund managers that are directed in all of those arenas. So meaning across the funds that I've invested in, I'm looking to sponsor diversity through my investing.
Martin, there's a question here that kind of you alluded to a little bit, but it's around like differentiation, right? Especially as you're kind of trying to position your fund to like an LP. And Court, you talked a little bit about this as well, like just being different. But Martin, maybe you can take this one. Any advice here for folks about how to kind of think about like differentiation in this market?
Well, I think it needs to go back to something that's authentic and different. Not just differentiation, like we're going to do a climate tech fund because Gartner says climate tech is a big category. I have a friend that just switched from being a software VC to a climate VC, and the biggest problem he had with LPs is that what's your authentic story in climate? Your track record in software doesn't necessarily track to that. So figuring out the authentic reason why you're in and you have an advantage in that particular category, or you're with your particular strategy, and spending a lot of time trying to figure out what that is. My personal differentiation is hard to replicate because I've just been investing forever, for 25 years, and it's my own personal connections, and also the fact that I am an LP in 17 funds. Court was talking about how he builds a portfolio of diversification. I build deal flow by being an LP in other in other firms, in other geographies that I'm interested in. For example, I just joined as an LP in a firm in Africa, and we just co-invested together in a deal. They did the local diligence and they helped in everything there, but I use my own personal fund of funds as a deal flow strategy where the LPs in my fund get an advantage of my own personal fund of funds. That's not capital from the fund, but that network of finding deals through my own LP interests and getting referrals is a differentiation. And the primary thing that I do for my pre-seed companies is to help them get follow-on financing. I think the number one job of a pre-seed VC is to get the next round done. And I have a 74% graduation rate from pre-seed to A, which is roughly 2.5 times your normal pre-seed investor. And part of the reason is because I spend a lot of time talking to GPs at other firms. I was just on the phone yesterday with Andreessen Horowitz, Battery, and Index Ventures, doing a monthly call with them to understand what they're looking for in the A and the B so that I can deliver them the correct companies. And having those direct relationships makes it easier for me to introduce my pre-seed companies to the right investors at scale. And I know those investors in my mind before I even write the pre-seed check. That's just something I've been doing for 25 years. That's something not a lot of pre-seed VCs do. They just pick deals and hope for the best. So anyway, I would encourage you to find some authentic differentiation that you have proven by executing it relates to better returns, or closing better deals, finding better deals, getting allocations, or generating higher returns, and explain what that is.
Love that. And then Court, maybe we can also double click on that together here. Do you have expectations of GPs post your LP investments, or anything you're looking for in particular after you do the investment?
Well, I was going to upvote Martin's comment on the advantages of investing your time in getting to know and developing relationship with the next level or two of VCs in your stack, right? So basically, like Martin, I spend an inordinate amount of time talking to VCs, funders, angels, et cetera, anyone that I think that just to maintain connections, and people will introduce me to folks, and I'll almost always take the meeting because it's hugely advantageous, even if I'm not directly investing right now, to know who's investing in what. And if I create a connection, then I can recommend them to a company or a fund who's looking to get the next round of capital invested in their thing. So I think that's a huge takeaway. Everybody should sort of make note of that. Don't just spend time looking for companies, make a fair amount of time looking for sort of down market or up market, I guess, depending on how you're looking at it, partners, right? That will help fund the companies that you get interested in. Or that if you see a company that you like, but you're not the fit for it, you can recommend them off to somebody else because you're doing them a favor. And likewise, they're likely to send you a deal in return in the future. So in terms of expectations, yeah, I love working with the GPs as an LP. I'm an active participant in helping the companies they've invested in. So once I become an LP in a fund, I make myself freely available to the GPs as a resource to work with their companies. Should that be available? Should that be of interest to them, right? I mean, and many of them take advantage of that. So I spend, as I said at the beginning of the call, a lot of time working with early stage companies to help them get through that, idea to product market fit phase that is so critical to ultimate survival. And, I don't know that a lot of other LPs do that. Many other LPs perhaps are just investing with their capital. I'm willing to invest my time.
Everyone, we have 25 minutes left. There's 29 open questions. Before you add another question, just walk through the list and just see if you can just upvote them for us so that we can prioritize them for Court and Martin, please. That way we can get through as many of them as possible over the next 20 minutes or so. I thought this question from Al for you, Court, was really, really interesting. When you're investing in funds, do you think of them almost like a VC and you're like almost like picking a company, or are you thinking more in terms of like a capital allocator? It's like, how do I like kind of move my money around to perform well, so to speak? Any insights on
both,
that?
actually. So I think I'm always evaluating the talent, right? Because like any company I invest in directly, a fund is only as good as the talent that's making the decisions. I call them, picking the pickers, right? So I need to pick the picker. Likewise, though, as I've said already, I do use my capital allocation to further my broader objectives of diversification, societal advancement, those things. Yes, absolutely. Those are filters that I use, because at the end of the day, if I'm deploying capital, I've got an infinite number of choices. I could deploy it in the public markets. I could deploy, it just depends. So my capital allocation strategy definitely informs where I spend my time in terms of talking to fund managers.
One more on that, and then I kind of want to shift over back to Martin. So from your perspective as an LP, when you're doing diligence on a fund manager, how do you think about if a fund manager has a lead strategy, so they want to be like a lead into these deals, or more of a follower? Any thoughts on that?
I tend to prefer. Okay, this is all very personal, so I'm not going to suggest that there's a right answer to that question. I prefer lead investors, only because that's the kind of mentality I have when I'm investing. It doesn't mean I wouldn't invest in somebody whose thesis was based around following. I think to me, I like the sense of conviction that it takes to be a lead. And because I often am investing in funds that are looking at very early stage, there's usually not a big check being written in the earliest stages, right? It's not a $5 or $10 or $15 million check. It's a few $100,000 to a couple million. And there's a good, in my mind, I like the mentality of lead investors, but that's just a personal preference. I don't think there's a right or wrong answer to that.
Martin, how are funding levels different based on geographies, especially within the United States? I know you look all over the country in general. Like, what have you seen? Any insights there?
There was a huge difference last year. Your average YC pre-seed company was coming out at 20 million pre, and in India you were getting into pre-seed companies at 3 million pre. I still see a bit of a difference there. I mean, I think YC has come down, but in places like India and Africa, you know, we did a $350,000 round at 3 million into this fintech middleware company in India, in Africa, that in their cost basis was 24 months of runway. It's incredibly cheap companies. And part of it, this is that in many countries, your runway goes farther just because it's cheaper to run companies. And, you know, it isn't always that the cheaper deal is the better deal. You got to look at, you know, the market size and things like that. But one of the reasons I do spend a lot of time in Southeast Asia and in India and Africa is that the risk reward, the value that you're getting for the capital and the runway that you're getting is an order of magnitude better than you have had in America for the last couple of years. But I'm seeing valuations in America for American startups come back down to more reasonable sort of traditional valuations, and I'm getting more comfortable with the runway in America. The other thing I'm seeing is that in pre-seed, personally, I'm only investing in companies that are raising fully funded rounds that are funding 18 to 24 months of runway in this environment. And the reason is because I think we're going into a get worse before it gets better, you know, in about 6 months time frame. And I don't want to have my companies that if I give them 12 months of runway, it means they're raising in 6 months. If my base case is that the funding environment is worse in 6 months, I don't want to be forced to be fundraising in 6 months. So, you know, you're seeing round sizes get a little bit bigger earlier to be able to give the companies 18 to 24 months, which I think is better, obviously, for investors because you're buying more of the company at the lower valuation.
Do you see any geographical or the differences within the United States as far as like valuations and things?
Yes, I do. And, you know, I just had a deal in Minneapolis, Minnesota, construction technology, 10-year contractor, built an internal tool for himself, wants to generalize it, sell it to other contractors, perfect founder market fit. That company in the Valley for that kind of founder would be a 10 million pre all day long. They have a product in the market with paying customers. They did the deal at 3.
Wow.
And I think that's definitely a geographic difference. In the middle of the country, you're getting a discount. Now, obviously, what you're hoping for there is that you're able to create enough traction and get customers outside their region to be able to attract more of a Valley type valuation in the next round. And that's how pre-seed investors are going to get an increase in returns by investing in those early companies. But I definitely see outside a premium for Valley companies and a discount for certainly middle America companies that are in places like Minnesota.
Question for you, Court. You know, what can emerging managers do to build a strong foundation for a long-term relationship with a potential LP? Like how can they start thinking about building relationships with LPs?
Well, if you're talking about somebody that's already invested in you, then obviously your track record is going to be the biggest success metric, right? If you're talking about somebody that is going to you're reporting as an investor, to Martin's point earlier, and I said, you know, authenticity and finding those common threads of interest. Investors may not choose, LPs may not choose to go with you initially. They may want to do a wait and see. But in the, you know, if you can demonstrate to them and keep the lines of communication open relative to your common interests and the things that, you know, where you've made a difference and something that they think matters. Again, you're not trying to beat everyone. You're just trying to get in that person's focal, you know, in their focal range in the moment where they're making their next investing decision. So, you know, remaining connected and staying on top of the things that matter to them.
Question, I guess, for both of you. just your thoughts on starting a new VC firm in 2023. Do you think this is a good time? This is like the most upvoted question. Obviously, I'm very bullish on this, but I'll have to get both.
I'm gonna let Martin answer that since he just did it.
You know, there aren't a lot of really valuable things that you can do that are easy. And you know, if it were easy, everybody would be doing it. As I mentioned before, I think the next 2 years investing early stage are going to be the best time to deploy capital in my lifetime, and I've been doing it for 25 years. There's just so many positive trends. You know, I got called 2 weeks ago by a team that got fired at Twitter, and they're starting something new. You know, you've got an amazing talent out there. Capital is a little harder to come by, but there's amazing founders to be started, and the cost of starting and running companies and getting market traction is lower than it's ever been. I'm incredibly bullish, and I encourage people to, you know, mine their own network and their own unique insight, and you know, go ahead and do it, because it's the best time in my lifetime.
I would +1 to that. I think it's a great time to start a fund right now. If you've got capital lined up and ready to go, and you can deploy in the next 24 months, I think you're going to do very well. The odds are.
Yeah, I can't agree more. You know, but to both of you again, kind of on this concept of like things being underfunded or different valuation, you know, maybe start with you, Martin. What sectors, is there any sectors or verticals that you think are like underfunded right now that you're excited about?
Yes, you know, I love old industries, you know, industries that have been ignored, not the cool ones. I mean, I do not want to see another buy now, pay later deal. I do not want to see another, you know, Slack alternative or something like that. You know, but you know, like this company I just talked about, construction. They're doing kind of like a Slack field communication protocol for construction workers in the field to communicate better between the project manager and the field construction worker doing plumbing or framing or something like that. There is a structural inefficiency in a construction site. I'm a developer. I've built like 5 buildings. It is a fucking disaster. And they do not have modern communication tools like office workers have with Slack and things like that. They're missing some pretty basic ways to communicate about their job and be productive. And so there are industries like construction that are still literally like 30 years behind office workers. And those have been ignored by the big tech companies for lots of reasons. But those are the kind of industries I love, is industries that have been ignored by technology, or just as importantly, some early adopter industries to technology that are now coming to the end of their life. For example, you all probably, and I wouldn't invest in this one because it's too concentrated customers, but you saw what happened with Southwest Airlines. Southwest Airlines reservation systems went to shit. You know what they're running on? They're running on a 1982 IBM mainframe that does not have connectivity to modern mobile platforms or Java technologies. It doesn't even, you can't even talk to it with an API. So you've got some industries like airlines that were early adopters in technology, but they adopted what is today 30-year-old pieces of shit. And those industries are going to have that second, you know, wave of developing technology platforms on modern cloud infrastructure with modern mobile front ends like that. They're going to go through a wave. Healthcare has a lot of those kind of opportunities too, where they, you know, built systems early, and you know, they're inflexible anyway. So I love the laggard industries in terms of technology today.
I'm gonna throw a little fuel on that flame, and that is, if you look at all the layoffs that are happening in the big tech companies right now, and you're also looking at where those laid off employees end up right now, they're not going back into big tech or even into startups. They're going into legacy industries. So the legacy industries of healthcare and construction and things that have had very few access to those top-notch tech resources are now gobbling them up at a rapid pace and reemploying them. And that's going to just +1 to what Martin's thesis is. I fully support that.
Again, this one's for you, Court, you know, because this is, again, something that's very important for you. So when you're investing or looking at diligencing a fund that has like a social impact angle, you know, what comes first? Is it the returns or the cause?
Oh, that's a great question. Well, let's see. I'll answer that by turning it around a little bit. My choice to fund things that have long-term societal good acts more as a prime filter. It is a primary filter to filter out the things that I'm not interested in. Okay, so I get approached a lot to make investments, as you might imagine, and I have to be able to quickly ascertain whether I'm going to spend any time learning more about a fund or a manager or whatever. And if the thesis doesn't align, it doesn't matter what I think their return profile is going to be. So I absolutely prioritize alignment with my investing thesis ahead of return. And I say that with full knowledge of the fact that I said earlier that I don't invest in, let's call it office efficiency, enterprise efficiency kind of plays, even though that's where a lot of my background comes from, because even though those could be extraordinarily lucrative financially, my belief is that the societal advancement stuff that I'm interested in is classically underfunded, right? It doesn't often get because it is harder to sell. It takes longer to mature. It's a tougher road to hoe to get to an outcome. And I'm willing to be patient and be one of those investors to take that longer road. So I guess in my mind, yeah, the thesis and the direction is more important than the potential financial outcome. That's just me personally. Again, that's very, very personal. So that's just depends on the LP.
This is a really interesting question to both of you. So both of you have done a lot of direct, a lot of fund investments. And how is your selection rubric different when you diligence a fund manager versus, say, a startup founder? And this is to both of you. Feel free to hop in.
Again, I go back to people. So I have a this is again, it's a funny thing. I after years and years of building teams for startups, I ended up having to construct a model for how to evaluate talent and build teams that didn't exist. So I have my own personal methodology of doing that. I would apply that similarly to a set of founders as I would to the founders of a early stage fund, right? Because at the end of the day, early stage, first time, however you want to define it, it's all about the people. And you know, the people that running it are going to make or break whatever the thesis is. Doesn't matter how good their area or the sector. So you know, for me, I'm always investing in people, 100%.
Martin?
It's the same. It's people, and for me, it is. I spend a lot more time on founder market fit than product market fit and founder stage fit. So, for example, I tend to not like to fund first-time founders who just got out of a 20-year career at a FANG and have never run a startup before, because you learn a lot in your first-time thing. And, you know, I remember hiring some people from Microsoft. The first question they said is, "Where's my assistant?" And I said, "You're working in a fucking startup. You don't have an assistant." So there has to be a mental headspace thing. That's why I like second-time founders, because they've sort of gone through the brain damage of, do I really want to do this early product market fit stuff? And am I willing to wear all the different hats that I have to as a CEO? So for me, it's about diligencing the founders, and are they in the right headspace, and do they have the right, you know, connections or unique insight to get what I call a thin edge of the wedge going in this market? Do they come with business development connections for you to get your first customers? Do they come with some technical insight there where they've built a better widget that's better than the things in the market? What is that founder market fit that makes the timing of this perfect? And does that founder have the right headspace and mental agility to succeed at the stage that they're at? And it's very similar for a manager in the venture fund too. Like I mentioned, is it a software guy now trying to do climate tech, kind of a state change that may or may not be successful, but it's a little bit of a flag? And is this manager going to be doing more of something that they have proven they can be successful at in the past? Or are they trying to come up with something completely different? For example, if I were to start a growth stage firm deploying Series B capital, I don't think I'd be very good at it. And I think LPs would rightly ask, why the hell am I doing that when I'm an early stage guy? That's the wrong founder market fit.
This is again, question for both of you. Both of you have done a lot of things in emerging markets outside the United States and things like that. And, the question is, do you think there's appetite of US-based LPs for emerging markets? I think both of you guys would agree that the answer is yes. But I thought the most interesting part of the question is, what are some of the extra considerations that you both take when you think about and do diligence on whether it's just to invest in a startup? You gave this example in Africa, Martin, or a manager in a particular country. What are some of the other considerations that you take as US LPs looking to invest in foreign countries? Martin,
for me,
start with you and then Court, or go Court.
Yeah, no, actually, Martin, go ahead. I'm gonna let Martin take this one first.
Well, one of the technical reasons that a lot of people don't think about, there are tax consequences because you're usually in a limited liability corporation. You have to understand your foreign tax liability and money transfer issues. And that's something to look at as either an investor or a direct guy. So for example, this company that I invested in Africa is in fact a Delaware corporation, and we're investing in a US corporation that owns the assets in Africa as opposed to an African corporation. So there's a lot of compliance issues around tax and legal structure. I'm invested, and I have recently learned this because I invested in an Indian corporation. We're now in a fight with the CEO, and we're having to fight in Indian courts as opposed to Delaware courts, which is not a very good thing for investors to do. So I would say that those are some of the primary considerations I look at, as the externalities in terms of tax liability, money transfers, and regulations for foreign investments.
And for me, it's that all of those things and knowledge and familiarity with the local market, right? So it's just, I don't know the entrepreneurs or the ecosystem in the parts of the world that these fund managers are operating in. They need to be the eyes and ears on the ground and making the right decisions. Again, it's picking the pickers. I'm looking for people that have connections, expertise, reputation that they value and want to uphold in an area. So those, on top of what Martin already said, I think those are good tactical things. And I'm also looking for just regional knowledge.
Amazing. A final question for both of you here. I know we're getting to the top of the hour here. What are your final parting words of advice for emerging managers or new managers that are about to start, a fund today? What are some final pieces of advice here? And maybe Martin, we can start with you and then we can end with you, Court.
Do it at any level that you can. If you can only raise $1 million, $1.5 million, raise that, make some investments, and get going. As I mentioned, I believe the next 2 years is going to be the best time to deploy capital in my lifetime. And, just do it. That's my suggestion.
Yeah, and I'll say absolutely agree with that. Along with some of this advice we already imparted, which has to do with just do it, and do it with an eye towards, not just making your investment, but figuring out at least the next investment after yours, or the next two after yours, so that you're maturing and managing relationships that will get you to that point with any new investments you look to make. Those absolutely, I think if you can do those two things, A, start a fund, and B, nurture downstream relationships, I imagine you're going to do quite well.
What an epic discussion, everyone. Thank you so much to both of you for imparting all this incredible knowledge on everybody here. Thank you.